His name was Hugo Stinnes. He worked as an industrialist in Mülheim an der Ruhr, Germany, in 1920. He was 50 years old, slightly built, with a dark beard, and the unhurried bearing of a man who had inherited coal mines before he was 21, and had never once needed to explain himself to a bank. He sat across the desk from his son Edmund, and said something that made no sense by the rules of the world. Edmund had been taught. I told him they were going to borrow as much money as the banks would give them, not to invest, not to expand operations, not to buy Germany, every factory they could find, every shipping line, every hotel and newspaper and forestry operation and ocean freight route the Reichsmarks would reach. Edmund asked what they would do when the loans came due. Hugo looked at him and said, "The loans will never come due, not in any currency that matters." He was not being poetic. He was reading a mechanism that almost no one else in Germany had identified clearly enough to act on. And within 3 years, he would be the most powerful private individual in a country of 60 million people, not because he was smarter than everyone else, because he understood something about the system, that the system was designed to prevent ordinary people from understanding. Here is what he understood. The German government had a problem it could not solve politically. The Treaty of Versailles had imposed reparations payments on Germany that totaled 132 billion gold marks, a figure so large it exceeded Germany's entire pre-war national wealth. The government could not collect enough in taxes. It could not borrow enough externally. So it did what governments in fiscal extremis have done throughout recorded history. It printed. In January 1921, $1 bought you 64 Reichsmarks. By July 1922, $1 bought 670 marks. Stinnes watched these numbers, the way a surgeon reads a vital sign. He was not alarmed, was taking notes. The viewer who watched the standard account of Weimar hyperinflation, the wheelbarrows, the bread that cost 200 billion marks, the middle class destroyed, was watching the consequence. Stinnes was watching the mechanism, and the mechanism told him something precise. Every mark borrowed today would be repaid in marks, worth a fraction of their current value. The debt would dissolve. The hard assets purchased with that debt would remain. The trick was to borrow in paper and buy in steel, coal, and shipping routes before anyone else understood what was happening. He understood it early, and he understood it completely. And here is what blows people's minds. The system he exploited was not an accident. It was a policy choice made by specific men in specific offices. And those men knew exactly who would win and who would lose. Understand first who Anna Eisenmenger was. She lived in Vienna, Austria, which ran on a parallel inflationary spiral to Germany's in the early 1920s. Her husband, a physician, had died before the war. She had done everything a responsible Austrian widow of the educated middle class was supposed to do. She held her savings in gilt-edged government securities, Austrian Kronen-denominated bonds, the most conservative financial instrument available to a private citizen. In 1914, her Kronen were worth 1/4 of a British pound sterling. In October 1918, her bank clerk pulled her aside and told her quietly, with genuine urgency, that she should convert everything to Swiss francs immediately. She declined. Dealing in foreign currencies privately was technically prohibited. She was a law-abiding woman. She trusted the institution she had trusted her entire adult life. By 1922, her kronen were worth 1/35,000th of a British pound. The same securities, the same account number. The number still printed correctly on the statement. But a fortune that had guaranteed her independence and her children's futures had become, in practice, nothing. She wrote in her diary, "My millions have dwindled to about 1,000 new shillings. We belong to the new poor. The middle class has been reduced to the proletariat, not because she made a mistake, because she followed the rules, because she trusted the institutions, because she did exactly what the system told her to do." 300 miles to the north, Hugo Stinnes was not following the rules. By 1922, Stinnes had borrowed Reichsmarks in quantities that would have been considered reckless by any conventional analysis, and deployed them into coal mines, steel mills, shipping lines, hotels, timber forests, newspapers, electrical utilities, and ocean freight companies. He stored his profits not in the currency he was being paid in, but in gold held in Swiss bank vaults. The same Swiss francs his bank clerk had urged Anna Eisenmenger to buy. He was not paid in marks if he could avoid it. He arranged his export revenues in dollars and foreign currencies wherever possible. By mid-1923, according to contemporary reporting, his industrial empire's value in real terms exceeded the entire German economy's nominal worth. The New York Times, in November of that year, documented how he derived billions in gains from routine commercial transactions that hyperinflation had inflated in scale. Time magazine, in 1923, called him the new emperor of Germany. The German press called him Inflationskönig, the inflation king. And he is wrong at precisely one moment. In the summer of 1922, when a reporter asked him whether he worried that currency stabilization would undermine his strategy, Stinnes said publicly that inflation was a regrettable but necessary tool for employment and population support. He framed it as a policy necessity rather than a mechanism he had personally weaponized. He was not wrong about the economics. He was wrong to say it out loud, because the mechanism he was describing was not complex. Borrow in depreciating paper, buy real assets, repay in worthless currency, and describing it clearly in public risk, making it legible to the population that was being destroyed by it. Is what the mechanism looked like from the inside of a steel acquisition in September 1922. The mark was trading at 670 per dollar. Stinnes borrows. Through one of the banks he now partially controls, 10 million Reichsmarks. He uses them to purchase a steel foundry worth, at that moment, approximately 14,900 in real terms. Records a liability of 10 million marks. 6 months later, with the mark at 30,000 per dollar, the same 10 million mark debt is worth 333 in real terms. He repays it from petty cash. The foundry produces steel. Steel sells into international markets for dollars. The debt is gone. The factory is his. The marks he repaid it with were effectively free. Not free because of accounting tricks. Free because the government had been printing currency faster than it was possible for prices to fully reflect the devaluation. There was always a lag between money creation and price adjustment. Stinnes operated in that lag, continuously, at scale. By late 1923, according to documentation cited by John Kenneth Galbraith in Money, whence it came, where it went, the Stinnes conglomerate encompassed 1,664 independent companies, coal mines, banks, insurance companies, railroads, and shipping lines, as well as interests in another 2,890 businesses. 600,000 people received wages from Stinnes. In a Germany of 60 million, roughly one working person in 100 was employed by a man who had started the decade with a prosperous but not extraordinary industrial inheritance, and had turned a monetary catastrophe into the largest private industrial empire on the continent. The question Financial Autopsy always asks is not, how did the winner profit? It is, who built the mechanism that made this outcome possible? Because Stinnes did not invent hyperinflation. He did not cause it. But the architecture of the collapse, the specific sequencing of paper money creation, the lag between money supply expansion and price adjustment, the legal prohibition on ordinary citizens holding foreign currency, the institutional channeling of middle-class savings into government bonds denominated in the depreciating currency. That architecture served specific interests. It wiped out fixed income holders. It destroyed savings denominated in marks. It transferred real assets, factories, shipping lines, land, from those who could not convert their savings quickly enough into those who could borrow in marks and buy in hard assets before the prices fully caught up. This was not accidental. The Reichsbank under Rudolf Havenstein printed money throughout the hyperinflation with explicit knowledge of the consequences. Havenstein, who had been appointed before the war and died in office in November 1923, delivered a speech to German industry as late as August 1923, noting that the printing presses were running at capacity and that new, faster presses had been ordered. He was not ignorant of what this did to holders of mark-denominated savings. He understood the mechanism. The decision to continue was a political one. It served the interests of industrial debtors, including Stinnes, and it destroyed the savings of the creditor class, the educated middle class, the pensioners, the widows, the holders of government bonds. Quick pause. If you are beginning to see the mechanism, not the event, the mechanism, hit subscribe. This is Financial Autopsy. Do not tell you what to buy. I show you how the system was built, who designed the trap, and who walked away when it closed. That is free. Like the lesson Anna Eisenmenger paid in 1923. The Stinnes Empire at its peak in late 1923 held interests in electrical generation, newspaper publishing, transatlantic shipping, Ruhr coal, Westphalian steel, Baltic forestry, and hotel chains from Hamburg to Vienna. He had acquired newspapers not primarily for political influence, though he used them for that, but because he owned paper factories, and newspapers drove demand for paper. He had entered banking not to become a financier, but to streamline his own access to credit. And every acquisition served the system. Every acquisition was financed by Reichsmarks that were, by the time he repaid them, worth nothing. He is wrong a second time in April 1924. He is on a hospital table in Berlin, recovering from a gallbladder operation. He summons Edmund and his other son, Hugo Jr., who are 27 and 28 years old. He tells them, and these words are documented by multiple sources, including Edmund S. later memoir, that what is credit for me are debts for you. I means it, precisely. His entire strategy depended on a specific environmental condition. A currency in continuous devaluation, a printing press that ran faster than prices could adjust, a lag between money creation and price discovery, wide enough to drive industrial acquisitions through. And he understood that once the currency stabilized, the debt would become real again. I understood that the sons he was leaving behind did not have his specific literacy about monetary mechanisms. I is wrong to believe the warning will be enough. Dies on April 10, 1924. As 54 years old. 11 days before his death, on March 30, 1924, the Reichsbank had introduced the Rentenmark, backed by a mortgage on German industrial and agricultural land rather than gold, and effectively ended the hyperinflation. One Rentenmark exchanged for 1 trillion old Reichsmarks. The era in which debt dissolved was over. Debts were real again. The Stinnes Empire, which had been built specifically on the dissolution of debt, was now carrying those debts in a currency that did not evaporate. Within 18 months of Hugo Stinnes' death, the conglomerate was at the brink of ruin. And Hugo Jr. fell out. Banks recalled loans. The same credit mechanism that had made Stinnes invincible under hyperinflation was now accelerating his son's unraveling. Hugo Jr. was eventually forced to sell half the company and shares to 2 American banks. A portion of the empire his father had built by draining the savings of the German middle class. I sold at distressed prices to the foreign creditors his father had so carefully avoided. By 1971, Hugo Jr. filed for bankruptcy, died in 1982, destitute at the age of 85. The man who could have inherited the largest industrial empire in Europe died with nothing. The pattern is mathematical. The outcome is structural. Not theory, not speculation. Historical fact. Now, the autopsy. Who were the named beneficiaries of the mechanism that destroyed Anna Eisenmenger's savings? This is the most documented. But he was not alone. Gerald Feldman, in his academic study The Great Disorder, documents a class of Weimar industrialists, Stinnes, Thyssen, Krupp, Kleckner, who collectively used the inflationary period to shed debt and acquire competitors. They had access to credit from banks they partially controlled. They had access to foreign currency through export revenues that ordinary Germans did not. They could borrow in marks and repay in marks, while holding their actual profits and reserves in stable currencies. The transfer was not subtle. It was documented in contemporary newspaper accounts, Reichstag debates, in the fury of the German middle class, who watched it happening and could not stop it. On the losing side, German government bondholders, life insurance policyholders, university professors on fixed salaries, pensioners on fixed payments, not small business owners who extended trade credit in marks and collected in marks that had lost 98% of their value by the time settlement arrived. The British economist John Maynard Keynes, writing in 1923, anticipated what the destruction of the German middle class would produce politically. He used the word disorder. He was understating it. The hyperinflation that destroyed Anna Eisenmenger's savings and built Hugo Stinnes' empire created the conditions. The resentment, the class rage, the collapse of institutional trust that made Germany's subsequent political history possible. This wasn't unique. The mechanism, currency debasement that transfers real wealth from fixed income holders to hard asset holders, has a documented parallel structure in multiple subsequent episodes. Hungary, 1946, the most severe hyperinflation in recorded history. The pengo lost value so rapidly that the Hungarian National Bank was printing a denomination called the 100 quintillion pengo. That is, 1 followed by 20 zeros. Industrial enterprises with real assets and access to foreign exchange survived, and in several cases expanded. Fixed income holders, pensioners, and small savers were destroyed. The pattern, identical. Argentina, 2001 through 2002. The government froze bank accounts, a measure called the corralito, and then forcibly converted dollar deposits to pesos at an artificially fixed rate, 1 peso per dollar. The peso then devalued to approximately 3 per dollar within months. Depositors lost 2/3 of their dollar savings overnight by decree. Who was protected? Those who had already moved assets offshore into physical property in Uruguay or the United States, or into dollar cash held outside the banking system. The mechanism, deposits destroyed, hard assets preserved. Same pattern, different continent. 58 years later. Turkey, 2021 through 2024. The lira lost more than 80% of its value against the dollar across this period. Turkish citizens who held lira-denominated savings accounts watched the purchasing power of those accounts collapse in real terms, even as the nominal number stayed the same or increased with interest payments. Those who had converted savings into gold deposit accounts. Turkish banks offer accounts denominated in grams of gold rather than lira, maintained purchasing power. Gold deposit account balances at Turkish banks more than doubled in a single quarter in 2024 as citizens accelerated conversion. The central bank knew the mechanism. The depositors who trusted lira savings did not. Here is the present-day parallel, and it carries a specific number. Global sovereign debt, the total of government bonds outstanding across all major economies, reached 91 trillion in 2023, according to the Institute of International Finance. The United States alone carries 36 trillion. The interest payments on U.S. federal debt now exceed the entire annual defense budget. 892 billion in interest payments in fiscal year 2024 versus 886 billion in defense spending. The historical record is unambiguous about what governments do when debt reaches a level that cannot be serviced through tax revenue alone and cannot be politically addressed through spending cuts. They inflate, not accidentally, not as a policy failure. It's a policy choice, because inflation is the mechanism by which the real burden of debt is transferred from the government, the debtor, to the holders of government bonds and fixed income savings accounts, the creditors. Anna Eisenmenger was the creditor. Hugo Stinnes was the debtor. The Reichsbank printed, and the transfer was executed. The mechanism is not new. It is not theoretical. It has been documented in primary source testimony, government archives, academic studies, and the final diary entries of people who did everything they were told and lost everything anyway. In 1924, a bank clerk in Vienna told Anna Eisenmenger to convert her savings to Swiss francs. It was breaking protocol. He was risking his professional standing. He was watching the mechanism operate in real time from inside the institution. And he was telling her clearly what it meant. She declined because the rules said no. She trusted the institution. She lost everything. Hugo Stinnes did not trust the institution. He studied it, understood what it was designed to do, and positioned himself on the correct side of the transfer it was executing. He died before the stabilization could fully unwind his gains. His sons did not understand the mechanism. They inherited the assets without inheriting the literacy, and the mechanism reversed, took it all back. Same pattern, same stages, same outcome. The forensic record does not tell you what to buy. It tells you what was built, who built it, and who profited when it collapsed. In every documented case of currency, debasement severe enough to destroy middle-class savings, the winners shared two characteristics. They held assets with value independent of the depreciating currency, and they carried debts denominated in the depreciating currency. In every documented case, the losers shared two characteristics. They held savings denominated in the depreciating currency, and they trusted that institutional promises about the safety of those savings would be honored. The Reichsbank honored its promises in the only way it could. It printed. The savers were paid in full, in marks worth nothing. The contract was technically fulfilled. The savings were gone. Here is what history shows. The mechanism is not designed to fail accidentally. It is designed to transfer, and the transfer always runs in the same direction. From those who hold paper claims on a depreciating currency to those who hold hard assets financed by depreciating debt. Now go read your bond statements before someone does the arithmetic for you.